Peach, Power, and Profit. This is your licensed neighborhood financial advisor, Chris Woods. And today I'm going to talk to y'all about how I'm structuring my portfolio, or how I've structured my portfolio in this economy that we're in with all the tension and things we're dealing with. So first, I got to have a safety bucket, especially in the business cycle that we're in, on top of any war or tensions that we have with other countries that affects our economy and the things that affect our economy that we do here. So right now, my safety bucket, I have 40% of my portfolio baked into this. So 20% is in short-term treasuries. That's like treasury bills that could last up to a year or a year or less, basically. I have 10% in a money market, basically just a glorified savings account, or I may have it in a money market mutual fund where I can earn interest on that money. Also, high yield savings account, which I also have 10% of my money in there as well. So that takes it up to a 40% allocation of my assets I have in my safety bucket. And the purpose of this, no drawdowns, it's safe. It's basically dry powder for opportunities. So we waiting on the sidelines, waiting for a crash. We waiting for anything or any opportunities that we get, in the next 6 to 18 months. All right, number two. So we hedging and we protecting. So our money, our physical dollars, because we know the value of our dollars don't hold its total value like it's supposed to because of inflation. So you buy or you hedge and protect that money by buying other assets. This is basically an asset allocation model. So number two is hedge and protection. So I have 20% of my money allocated to this, which is 15% in gold. And that could be gold stocks, gold miners, or physical gold itself, where you buy gold coins or gold bullions or gold bars. Reach out to me if you need help doing that. Also, I have 5% allocated to other broad commodities, oil, wheat, things like that. So a total of 20% is in hedge and protection for the portfolio. And the purpose of this is to protect against inflation, geopolitical tension, oil, war, currency risk, all that stuff matters. All right, number three, equity growth. I have 30% of money dedicated to this part of the portfolio. 15% is dedicated to the broad market. That's like an index fund or maybe a glorified ETF, something like VTI, or, if you have the funds, S&P, SPY, and so forth and so on. Any index or ETF that tracks the market, you can allocate money towards that. So 15% of my money is in that. 10% is into dividend plays like ETFs. 15%, you find you're a dividend fund that provides a certain amount or certain percentage of dividends that's high, but it has to be value, of course. And so 10% goes there. And then 5% is, for a little bit more risky equity growth. So something in tech, maybe AI, maybe a solid AI company you can put your money in right now. Maybe even the triple Qs, because even though, things are going on, the market is still, outperforming and hitting all-time highs damn near every week. So, it's still a safe bet for now, but we allocate a small percentage, like 5%. So that's a total of 30% of that, my money going to that part of the portfolio. And the purpose is controlled growth without going all in on the hype. Yeah, because it's not time for that at this current moment. Number four, so opportunistic, high conviction. We only donate to 10%. To this part of the portfolio, and energy, oil thesis, basically, dealing with Iran and those tensions and war, the Strait of Hormuz and things like that. We can allocate 10% of the portfolio to that, also to real estate, and also REITs, real estate investment trust. We donate a small percentage of that, and other tactical plays, anything that comes up, maybe Bitcoin or some other crypto that we can invest in, and basically get in and out of pretty quickly, make some money, basically a trade. Something small. So 10% goes to that. That's the smallest allocation that we have. And that brings us to 100% to our portfolio being complete. And the purpose of this was to basically outperform the market. So we do that. This is called basically an asset allocation model. You dedicate particular or certain amount of money to particular sectors and industries of the market to, get a return on your investment or make investments to protect, hedge, grow, so forth and so on. And it's really just simple all around. It's really basically, if the market crash, you got bonds, you got short-term treasuries, you got cash on hand. If inflation spikes, you got gold, you got commodities. If the economy grows, you still got stocks to carry your returns. And if chaos hits, you're hedged. So you cover everything and you protect yourself from everything with having this allocation model to protect against everything that may come, may or may not come. So at the end of the day, you're protected, you're hedged. This is how you win in any environment. So if you have any questions, please reach out. I have no problem helping anybody to set their allocations up and pick the best investment style for you and your future. Peace.